What about the stock market, Louise? Because we had obviously the move over 14,000 in '07 a couple of times, right? And then we had the collapse down into the mid 6,000s, low 6,000s. And now we've had this rally. What are your thoughts? Secular bear market rally? What's going on here?
Well, that's what our thoughts have been, that in 2000 we started to identify the possibility that we were entering a structural bear market. We've only had 3 prior structural bear markets, long-term, multi-year, 13 to 16 years, bear market events. One was 1966 to 82, which was a more or less horizontal pattern around a pivot low of 1974, and that was a period of inflation and rising rates. And then you had the 1929 to 42 period, which was an irregular pattern, encompassed a crash, and that was a period of deflationary pressures and very low to falling rates. The third one was 1905 to 1921, and that was another horizontal around the pivot low of the war period, 1914, and that was also a period of rising rates and rising inflation. So by what I've just described, there's an alternating pattern, and Elliott Wave's alternation of cycles suggests that any cycle in life is less like the immediately prior cycle and more like the alternate cycle. And it's probably because we don't learn from our grandparents' generations as much as we ought to. So we suggested in 2000 that our structural bear market experience, which we felt we were just entering, would be less like the prior, which was inflation and rising rates, and more like the alternate, which unfortunately was 1929 to 42, of deflationary pressures and falling rates. And we have tracked that to such an incredible degree, not only the 2-year crash into 2002, but then you had this incredible 5-year rally that we saw into 2007, which was identical in pattern to the 1932 to 37 rally. One of the things that kept us very much on alert in studying that alternate period was that there was no real technical warning in 1937. The advanced decline line did not give its usual 4 to 6 to 9 months deterioration prior to the market decline. It happened quite rapidly. So as we saw the home builders unwind in 2006 and financials start to unwind in 2007, we became quite concerned that we were moving into a reversal of that period, which was identical to the 1938 49% decline. We saw the Dow down 54%, S&P down about 57%, and thereafter there was another very sudden reversal that took the market up 60%, and that's the rally that, if this correlation continues to hold, we've called it our alternate hypothesis, we are already at that 60% rally point, more or less. So we're on alert here. Yes, the markets are in uptrends. Yes, they were in uptrends in 1938. But one of the things that was very telling about the 1938 to 42 period is that they had about 8 reversals, cyclical bull, cyclical bear, 20% up, 20% down, all the way until the final low when the next bull market started in 1942. And during that period, the generally accepted market signals did not happen correctly. The advanced decline line did not give you any warning. It essentially went sideways. The momentum studies that give you long-term buy and sell signals were all wrong in terms of their timing because too many reversals took place in too short of time for those long-term indicators to unwind properly. So you got sell signals near the low and you got buy signals near the top. So it's a very unsettled period, and all of those structural bear markets divided into what we consider declining phases into the pivot lows or the crash low, and then the repair phase in which you get these cyclical rallies and retreats for a number of years until enough repair has taken place, backing and filling and rallying and retreats to establish some kind of extended consolidations that allow for the potential for the next structural bull market. And we don't expect that for quite some time, certainly not before possibly 2012, 2016, and the 40 and 20-year cycles actually extended out to 2022.
Let me ask you, Louise, about bonds then, because it's had such a major bull market for such an extended period of time. When you look at the cycles there, when you've looked at the charts, is this a time where you can see we're getting close to entering a bear or danger zone?
Not yet. I think that one of the very interesting observations about our 200-plus year history, 210-year history now, almost in the bond market, is that the cycles for interest rates have been very long, Eric. They've been 22 to 37 years. So the last cycle for rising rates began in 1946 and ended in 1981 when we had the sharp reversal, and in 1981 we went into what's still the current bull market for bonds, so it's already 29 years old almost. And one of the interesting observations about the prior 7 cycles that have occurred is that the reversals from rising rate cycles to falling rate cycles have been very sharp, inverted V affairs, just like what happened in 1981. But the reversals from falling rate cycles to rising rate cycles have taken anywhere from 2 to 14 years. So that's a transitional trading range that we started to call for in 2003, that we might be moving into a transitional trading range in which bonds would fluctuate at a low level between, say, 3.5 and 5.5, or obviously got a little bit below that, which is perfectly fine. And the reason that we anticipated this transitional range is because each of the other reversals from falling rates to rising rates occurred in these deflationary pressured periods. 1946 was the beginning of the last rising rate cycle, but recognize that that was 14 years after the bear market low of 1932. So those deflationary pressures kept rates low for a very long period of time. And we suspect that that's what's underlying the current interest rate low maintenance of low rates today, and we think that it probably can go on for a period of time. The question becomes the long end from us, and we rather suspect that the long end may prove the canary in the mine, so to speak, because we're issuing so much debt and deflating our dollars so much that one has to question how long some of the external countries that have been buying all this debt are going to tolerate the depreciation of those assets. And as and if they cease to buy, which many countries already are beginning to do, or buy less, somebody has to buy it, or else interest rates are going to have to go up at the long end to entice people to buy it. At the moment, the Fed's been buying it. Well, that's sort of like the dog chasing its tail. I mean, how long can you issue at one end and buy them back at the other end? I don't know, but I don't think it's going to last forever. And therein is the cycle that takes you to gold, because as the currencies become more and more fiat and other countries print theirs to try and keep up with ours so that they're not economically pushed out of the world cycle, then you're going to have quite a few fiat currencies, and gold becomes the hedge against the fiat currency more than the hedge against inflation at this point in time.
Let me ask you something I posed to other guests, Louise. Obviously, the economy in the United States, we're having some effect from the stimulus. That's natural, even when you go back to the French model, where they would, before their currency collapsed, print money over and over and over. That was always the solution into the currency going into oblivion. But you do have a little bit of a bounce, so we're seeing that now. But if the United States economy continued to struggle, or struggle tremendously, from what you were just explaining to me, because it is the dog chasing the tail, you could have a situation where this economy is in potentially horrendous condition, but you could also have higher interest rates thrust upon this nation via the fact, as you said, that the foreigners stop buying because they're demanding higher interest rates and offset the risk, or reflect or resemble the type of risk they feel like they're taking. That could usher in a depression, could it not?
I'm not an economic specialist, so I don't want to speculate on what would happen if that were the case. But certainly the long end we anticipate going up before the short end, because they probably wouldn't be able to raise the short end as long as you continue to have the economic problems. But the long end is more or less out of their control, simply because they're owned outside the country to a great degree. And our definition of when the new interest rate rising cycle comes into play is with the definitive crossing of 5.5%.